Don't have a lot of envy, you don't have a lot of resentment, you don't overspend your income.
The first $100,000 is the toughest hurdle you'll ever face in building wealth. It's not just a number, it's a test of character, discipline, and sheer willpower. Everyone fantasizes about hitting millions through clever investments, side hustles, or viral ideas, but until you scrape together that initial six-figure sum, you're essentially starting from scratch. It's like trying to start a fire with damp matches. It takes endless friction before you see any spark. The reason it's so challenging: you begin with little to no capital, and small amounts don't seem to grow fast enough to matter. But that's the illusion that traps most people. They see tiny returns and quit, opting for instant gratification instead. To reach that milestone, you have to adopt habits that feel counterintuitive and uncomfortable. Save aggressively even when it seems futile. Invest modestly despite the skepticism from others. Resist the temptation to splurge on luxuries that drain your resources. When you're just starting out, a few $100s saved might only yield a handful of interest in a year, and it's easy to dismiss it as pointless. That's the trap, prioritizing short-term pleasures over long-term gains. But those who persist discover the magic. Consistent small actions build momentum over time. Once you cross that $100,000 threshold, everything shifts. Compounding starts to work noticeably in your favor. A reasonable return on that amount can add thousands annually, making the effort feel rewarding at last. The majority never make it there, not due to lack of opportunity, but because of impatience or poor choices. They chase quick wins, like risky bets or trends, thinking wealth demands genius-level insights. In reality, it's about endurance, staying the course long enough for growth to accelerate. Think of it this way: accumulating your first $100,000 is like climbing a steep hill with a heavy load. Every step is grueling, and progress feels slow. But once you reach the top, the descent is smoother, and gravity pulls you forward. The habits that get you there: frugality, consistent saving, smart investing, and tuning out distractions, are the same ones that propel you toward greater wealth. It's straightforward in theory, but demanding in practice. No one can bail you out if you don't prioritize saving. Even the best strategies fail without a foundation. The key is to outsmart the average mindset. Avoid comparing yourself to others who flaunt superficial success. Don't overspend to fit in. Steer clear of borrowing for non-essentials. Ignore fleeting hype. Stick to this for years, and that first $100,000 will arrive, followed by faster milestones. Early on, it might mean foregoing vacations or fancy gadgets while peers indulge. But that discipline pays off exponentially. Crossing that line doesn't make you wealthy overnight, but it proves you can delay gratification, a skill rarer than talent. If you're starting young and feeling overwhelmed, remember, persistence outlasts cleverness. The system rewards those who endure the initial grind, turning the unbearable into the inevitable. One of the biggest obstacles to building wealth is the constant pull of comparison. It sneaks in quietly, making you question your choices when you see others seemingly thriving. This mindset is a silent killer of financial progress because it fuels unnecessary spending and risky decisions. Why bother? It offers no upside, only resentment and distraction. Observing lives derailed by this, it's clear. Fixating on what others have blinds you to your own path. Instead of focusing on outpacing someone else, channel energy into your own growth. When a colleague upgrades their lifestyle dramatically, it's tempting to follow suit, but that often leads to depleted savings. The cycle is predictable. See something desirable, feel inadequate, spend to catch up, and repeat until resources are stretched thin. Breaking free means recognizing that true progress comes from internal benchmarks, not external displays. Those who avoid this pitfall save more consistently. They build habits around what matters, accumulating assets rather than appearances. The numbers bear it out. Saving a steady amount annually compounds into substantial growth, while chasing status leaves you with regrets and obligations. It's not about denying yourself joy. It's about choosing sustainable satisfaction over fleeting highs. In practice, this means evaluating purchases not by how they make you look, but by their long-term impact. A modest approach might seem dull, but it creates stability. Those flashy displays often hide underlying fragility, loans and facades that crumble under pressure. By contrast, a low-key strategy builds resilience. The reward: faster progress toward key milestones like that first $100,000, and the freedom to laugh at the illusion of others' superiority. Ultimately, this poison is self-inflicted. Opting out leaves you clearer-headed and better positioned for real success. Everyone makes errors on the road to financial stability, and some sting more than others. One common regret is parting ways with promising investments prematurely. It's easy to feel clever when something appreciates quickly, but locking in gains too soon can forfeit massive future growth. Imagine spotting a solid opportunity, watching it rise, and cashing out only to see it soar further. That impatience can erode potential fortunes. The challenge in investing isn't just entry, it's endurance. Holding through fluctuations requires ignoring the noise and trusting fundamentals. Many assume activity equals progress, but often, stillness yields better results. Jumping in and out based on short-term swings erodes returns through fees and missed opportunities. The real edge comes from identifying quality and giving it time to flourish. This ties into a broader issue: balancing action with restraint. Clinging to underperformers is equally damaging, but the urge to do something often leads to hasty exits from winners. Reflecting on such moments teaches a valuable lesson. Question whether changes in value reflect core shifts or just market whims. More often, it's the latter, and resisting the itch preserves wealth. To avoid this, cultivate patience as a core trait. View holdings not as quick flips, but as long-term partners in growth. The irony: what feels like inaction is actually strategic, allowing compounding to amplify efforts. Those who master this outpace the restless majority, turning potential regrets into stories of quiet triumph. Overconfidence is another wealth destroyer, often masquerading as expertise. People dive into decisions with unfounded certainty, only to face harsh realities. True wisdom lies in recognizing limits swiftly. Admitting gaps in knowledge isn't weakness, it's a safeguard against costly blunders. In fields like investing, this is crucial. Headlines spark instant opinions, leading to impulsive moves without depth. Success stems from focusing on familiar territories and bypassing the unknown. This selective approach isn't restrictive, it's protective, filtering out noise and preserving capital. Building this humility involves defining your expertise boundaries and respecting them. Ego often pushes beyond, driven by the desire to appear insightful. But feigned knowledge invites disaster. Instead, embrace questions and doubt. They lead to better outcomes than baseless assertions. The benefit: fewer missteps, more consistent progress. In a world of loud proclamations, quiet discernment stands out. This mindset accelerates the journey to financial milestones by emphasizing quality over quantity in decisions. Many approach wealth through traditional paths, climbing hierarchies, seeking approvals, and trading time for paychecks. This employee mentality caps potential, as growth is tied to external validations. True prosperity comes from ownership, controlling assets that generate value independently. Shifting to this view means prioritizing equity over salaries. Whether through businesses, stocks, or properties, ownership unlocks uncapped upside. It demands risk, but rewards with autonomy. Employee thinking focuses on immediate security. Ownership eyes enduring legacy. This isn't about abandoning stability outright, but integrating asset building into your strategy. Even small stakes compound over time, outstripping wage inflation. The transition feels daunting, but it's liberating, replacing dependency with self-reliance. Those who embrace this build wealth sustainably, turning efforts into multiplying returns. It's a mindset revolution, from performer to architect, ensuring long-term freedom. Economic downturns offer stark lessons in preparedness. Witnessing widespread hardship highlights money's role in resilience. When resources scarce, survival hinges on prior habits. Key takeaways: prioritize liquidity, shun excessive debt, and maintain conservatism. Debt amplifies vulnerability, turning minor setbacks into catastrophes. Those unburdened weather storms better. Resilience trumps speculation. Conservative strategies endure where aggressive ones falter. These periods also reveal optimism's power. Recovery follows turmoil. Balancing caution with faith in rebound guides smart actions. Preparing as if challenges loom, yet investing for growth, creates equilibrium. This duality fosters discipline, turning adversity into advantage. History shows cycles repeat. Learning from them builds unshakable foundations. To accelerate wealth, eliminate 3 common saboteurs: debt, unnecessary conflict, and poor associations. Debt erodes freedom, demanding future earnings for past choices. Avoid it unless essential, favoring self-funded paths. Conflict drains energy, avoidable disputes, toxic dynamics, diverting from productive pursuits. Life's inherent challenges suffice. Manufactured ones compound stress needlessly. Associations shape outcomes. Surround yourself with reliable, positive influences. Sidestep those fostering negativity or unreliability. This curation simplifies life, enhancing focus on growth. Together, these eliminations create space for compounding, turning potential into reality. Enduring collaborations amplify success when built on trust, complementarity, and shared values. Trust eliminates suspicion, enabling seamless cooperation. Differing strengths balance weaknesses, while aligned principles minimize friction. Disagreements, handled rationally, refine ideas without ego clashes. Not flawless, such bonds weather misses through mutual respect. Beyond profit, shared ethos sustains longevity. Finding or becoming a worthy partner starts with integrity. Simple foundations, trust, balance, respect, yield extraordinary results. Wealth often arrives as an unintended consequence of consistent, rational habits. Aiming directly for riches invites shortcuts. Focusing on avoidance of folly, overspending, risks, leads there naturally. This involves saving diligently, investing prudently, and enduring boredom. It lacks glamour but delivers. Discipline, not motivation, sustains it. Overshooting goals stems from underestimating compounding's power. The byproduct: independence and peace, with abundance following suit. No trick overrides the fundamental. Live below your means. Without surplus, no foundation exists for growth. This enforces discipline early, making the first $100,000 a proving ground. High earners falter here, outspending incomes. Consistency in saving trumps brilliance. Excuses abound, but the principle holds universally. Embrace basics. Save, invest, persist. The grind yields transformation, turning effort into momentum. It's unglamorous but effective, rewarding endurance with inevitable progress.